Welcome everybody to a special three-part series here of the Mortgage Insiders reporting. Today we have a very special guest on here, April with Accountwell Co. She's one of our favorite local accountants here to shed her wisdom on a few things. So obviously there's so much in the accounting world that we want to share with our listeners today. So we've actually broken it up into three videos. So we're doing a three-part series. And today we're going to be talking about business for self. So such a hot topic. I know a majority of Canadians, correct me if I'm wrong, I think like it's almost close to 50% that are actually self-employed or in one way, shape, or form self-employed technically. So we're really gonna dive into that. But April, thank you for being on our show here.
Thank you for having me. I can talk all day about different topics for small business owners, so I'm happy to be here and shed some light on your topics.
Yeah, awesome. I guess okay, what questions do we have for April today?
Yeah, April, welcome to Mortgage Insiders Edition. So, our world, mortgages and accounting, I think it's very much intermingled. Every time we have to basically tell our clients to go back to their accountant and bring certain set of documents. And especially if it is a self-employed client, then we 100% rely upon our accounting partners. And that's the reason why we thought we should bring in an accounting partner and they can share their wisdom, what they basically see in the day-to-day life and how everything works out when it is especially a self-employed client. So first question that always comes to our mind, what we have seen in the past, Kim and myself, both of us have seen is uh, any kind of clients, basically now they are very easily becoming incorporated. And first thing, basically, they are, if they're not working for somebody and if they are subcontracting. And what we have seen also is the employers are also getting smart. They don't want to take on major responsibilities like medical benefits and all those stuff. And what they're telling these clients or these, let's say, their employees that let's do a contract thing, right? So subcontracting, that's another word for it, right? And they ask the clients to incorporate basically themselves and go from there. So April, the first question comes up is when do do you recommend the clients should basically incorporate, and what do you see, like what are the pros and cons for that?
Yeah, so I think when it comes to incorporation, there's always kind of two big objectives to accomplish with that. There's the objective of reducing your liability, the objective of saving some taxes. And I think just a side note with the incorporated kind of service provider, there's something called a personal service business, which is like an incorporated employee. Totally a different topic, but just for anyone listening, if you are an incorporated, an employee that went to being incorporated, just something on your radar, personal service business, make sure you look it up first. But one of the advantages of having the corporation is then being able to have a separate entity where you can shelter your income and have a lot more control, be at the steering wheel of how much taxes you pay.
Mhm.
Obviously, with that, if you want to reduce your taxes, you're going to reduce how much you pay yourself from your corporation. So by minimizing how much income you draw from your corporation, you'll have a lower tax bill. As it intermingles with your business, the lower income you have, sometimes the less borrowing power you can
Yeah,
have.
yeah.
So if you're looking at, getting lending, a mortgage or a car loan or any sort of major financing, it's really important to have a discussion between your lender and your accountant of finding that sweet spot of how do I have a lower tax bill, but at the same time accomplish my lending goals.
hmm And would you recommend, because again, we see this on the daily. I have a lot of clients in oil and gas that will say, "Hey Kim, I'm no longer working with like Synovus or something. They've
Mhm.
offered me a contract. Should I just
Mhm.
incorporate right away or should I just stay as a sole proprietor?" Because there are two differences, right? Like
Yeah.
going to incorporating, I guess you are more in control, but like as a sole proprietor, then like I'm assuming all income would be claimed, correct? And then
Yeah, so if you're operating, so you don't take the step to incorporate, which a lot of people kind of have a misconception of, I'm a subcontractor, I should immediately incorporate, and that's not always the case. Incorporation really comes down to, are you making more money than what you need to live off on a daily basis? Is there an opportunity to save taxes because there's excess profits? So if you are making, say, 150,000 as a contractor at Synovus, but you need the majority of that or all of it to pay for your family's living expenses, incorporation might not be the best option for you, in which case you would stay operating as a sole proprietor. And in that scenario, all of your income is taxed, regardless of how you use it or what you spend it on, unless you're putting it into a tax sheltering strategy like RSPs. But yeah, so if you don't incorporate, you would be a sole proprietor, in which case your taxes are quite straightforward. And for lending, you would just have your T1 general on your T21-25 schedule, where all of that income and those like correlating expenses would be reported.
Yeah, so those expenses basically are, I believe, the kind of incentive to write off those expenses is the incentive for some of the clients that they would sometimes are not guided properly that should they incorporate right away or should they stay as a sole proprietor, right? So that basically, just to remind our viewers and listeners, when you are self-employed, the lenders all across Canada, banks including even credit unions, they are looking for 2 years income history, full 2 years calendar history, and January to December, and then only they will take average of that income if that income shows a growing pattern or at least consistent. If it is a declining income, then they will use a lower numbers, right? So that's the reason why we always recommend, Kim and myself always recommend that you should talk to a professional accountant who's a CGA CPA and basically go and seek their guidance and go with that step before. Yeah, am I right, April?
Yeah, and I would say it is important to have that kind of professional marriage between your, your roster of your lawyer, your accountant, your mortgage professional, because sometimes there's different decisions that come into play when we get to tax time. If we know that you're going to be applying for a mortgage in the next year or two, I know it sounds a bit backwards, but we might be in a situation where we want to scale back some of your expenses or not be so aggressive with certain expenses so that we have that taxable income level that you need to accomplish your lending goals. So it is important that all your kind of team knows what's going on the short-term and sometimes long-term horizon so they can make sure they're implementing the right strategies along the way for you.
Yeah, I totally agree with that too. Because honestly, I find the biggest mistake I see a lot of self-employed clients do is that, they just claim whatever without consulting their accountant, without consulting the mortgage broker. And, if you just claim whatever, I had a client who was like, you know what, Kim, I'm just going to claim 20 grand this year just because. But so now I was like, and if you want to buy a home, like now you got to wait another 2 years to declare more income in order to qualify. So
Yep.
there are, you do have to keep that into consideration. And that's why I can't stress, like, you got to have a solid power team, especially if you're self-employed. You need to have a solid power team, especially if you have some financing goals you want to achieve. And then, but it's not to say that, that client who claimed 20 grand can't get a mortgage. You still can, like on our side, like Preet and I would probably, you may have to look into alternative lenders, which means higher pricing, right? It's going to be more expensive. So at that point in time, does it make sense, right? Like it's, yes, you're saving taxes, but on the other hand, you are paying it somewhere else. So
I know. I always say planning, it's so much more beneficial when it's proactive and not reactive. So it's, even if you're like, maybe I don't need to think about this stuff yet, it's always a good idea to reach out, have the conversation early, because it's much easier to adjust things ahead of time than, down the road, you're like, okay, oops, how do I clean this up? And now everyone's kind of scrambling to put together the best result for you.
Mm-hmm.
are there any additional costs, I guess, April, like when someone is considering, should I stay as a sole proprietor or should I incorporate? Are there any additional costs that clients should be aware of? I always heard that it would be a little bit more costly to incorporate because there's people, right?
And I always remind people, you want to incorporate when you're going to save more in taxes than what it's going to cost to maintain that corporate structure. There has to be a cost benefit analysis. When it comes to incorporation, there's going to be a couple $1,000s usually just to get off the ground, to get a corporation set up, to get the new bank accounts rolling, to have a conversation with an accountant, a lawyer. If you have business partners, I highly recommend having a shareholder agreement, which can also add a couple $1,000s in cost. So there's definitely some liftoff costs. And then there's the maintenance costs on an annual basis. So As a sole proprietor, it's very cost effective to just have your personal tax return done, have a bookkeeper do your accounting throughout the year. But when you incorporate, you often have to beef up, the level, the quality of your books, and you have another corporate tax filing. You have some, legal maintenance costs. So, we're talking a couple $1,000s at least every year just to have the bare minimum, like a simple company. So the cost can climb up from there depending how large your business is. So again, you have to make sure you're saving more in tax to outweigh the cost to go it. But oftentimes what we see is the tax savings far, far outweigh what the maintenance costs are to run your corporation. But talk to a professional because they'll be able to look at your unique, specific situation and make sure you're pulling the trigger or making sure you're making the decisions at the right time, because so much of it is timing.
Okay. One other question, April, that always comes in front of me is sometimes clients ask me when they are incorporated, should they basically generate a T4 or a T5? Which one is better? So if you could add on to that.
Yeah, this is a really fun question because this is a lot of the work that we do with clients is looking at, because it's not just a black or white decision. Even though us accountants love our black and white. So it really depends on the client. It depends kind of the stage in life they're in. Especially with our female clients, like, are you taking time off to have kids? Is there childcare expenses? Because a lot of these different tax credits or tuition tax credits, they interplay differently with employment income versus dividend income. So there's no real kind of black or white answer of is one better than the other. It really just depends on the client. I don't know, have you guys seen situations where one is better to lend against than the other for self-employed clients?
No, nothing like that. We normally see is equal money is pretty much divided between both of them. The accountants are doing it, and I don't even know if that is done intentionally or basically it's just done for the convenience. I have no clues, but
like it doesn't really impact your financing whether you pay yourself fully in a T5, like dividending, or fully in a T4. Honestly, at the end of the day, majority of lenders are looking at your total income, the line 1,500 or whatever it is, right?
That's good to know,
yeah, that's really what we're looking at. Because I don't know, I feel like there was a big misconception where people would say, oh yeah, it's better the T4 versus T5. No, guys, like that. Preet and I are going to break down that myth, and that is not true. So
yeah, but for some lenders, what I have seen is when it comes to gross up of the T5 income, the dividend income, some lenders may not agree with that. They may not gross it up, especially for sales commission jobs. Right, Kim, if I'm correct with that, right? So they will not gross it up. They will gross up the T4 income, but not the T5 income. So they will straightforward use the T5 income mentioned on the T1. Yeah.
I think that's why, like I said, there's small little nuances here and there, but majority of it though is pretty straightforward. 2 years, taking a look at your income, average income, and for our listeners out there, as long as you have that number in the back of your mind, it's essentially the conservative way of looking at it. But
that's good to know. Yeah, so I think the important thing in that scenario when comparing one to the other is making sure you're picking an income that's most tax efficient, and the lending will kind of serve itself afterwards. So that's good.
Absolutely.
Awesome. Well, thank you again, April, for joining us. Like, any last words of wisdoms from you, especially for those who are self-employed out there?
Yeah, when it comes to incorporating what time, like I said before, timing is everything. Have the conversations early about when to incorporate, timing that with your mortgage or lending or restructuring. Just have the conversation early and talk to your team. Always the biggest takeaway.
Okay. Awesome. Thank you very much, April. We will see you in the next video. And thanks again for your insights.
Bye, guys.